We continue with the second video lecture. In this question, Seco had inventory at the beginning of the year of 620. Sales for the month amounted to 985,000 and purchases were 700,000. At the end of January, a fire in the warehouse destroyed some inventory items. The owners salvaged inventory valued at 180,000. JECO operates a markup of 25%. What is the cost of inventory destroyed in the fire? So at the beginning of the year or at the beginning of January, that 620 is a correct figure because that's what they had before the fire. The purchases are also correct. So using the markup formula, we know the sales are 985. So we can compute the cost of sales using the markup. The markup is 25%, so we know our sales will become 125%. The sales were given as 985, so 985 is equal to 125%. Therefore, the cost of sales will be 100%. So we cross multiply. 100 times 985,000 divided by 125,000 gives us cost of sales of 788,000. We can now substitute the cost of sales of 185,000 in the cost of sales formula. The opening inventory were given as 620 and the purchases are 700. So 620 plus 700 gives us 1320 minus the cost of sales that we've computed to give us what should have been the closing inventory of 532,000. Then we subtract what was salvaged, 180,000. So the inventory destroyed in the fire was 352,000. So that's how we work that computation. So there are other techniques for solving incomplete records, which we are going to demonstrate in this question. ECO has recorded the following details relating to trade payables. You've got the balance of the trade payable at the beginning of the year and the balance at the end of the year. Cash paid from till, and then you've got payments from bank. They're required based on the information provided to calculate the value of purchases made during the year. To compute the value of purchases, we need to draw a T account for the trade payables. A payable has got a credit balance, so the opening balance of 38,450 goes to the credit. Then we're told cash paid from till. When you pay out cash in the cash account to be credited, so in the payable account to be debited with a 430. The payment of 167 also from the bank will be debited in the payables because it's credited in the cash account. Then we bring in our closing balance of 43,825. Then you balance off the accounts by adding the side which has got the highest figure, which in this case is the debit side, which is giving us 211,874. So you take the 211,874, the other side, and then subtract from the opening balance to give you a balancing figure of 173,029. So that's your figure for purchases made during this period. Any question? In this question, we told BCO maintains a cash float of $50. In 20X7, all receipts from credit customers were banked after the following payments from the till had been made. Now, when you're told you maintain a cash float of $50, what it means is that your opening balance should always be 50 and your closing balance, when you add the cash on hand plus the vouchers, should also be equal to 50. That's what it means. So you need to open a petty cash account. Since you are told there were some receipts from credit customers, you also need to open a trade receivable account. So you'll be working with two accounts, a cash account and the receivables account. We are told total bankings in the year amounted to 28,457, and opening and closing trade receivables were 1447 and 1927 respectively. So we're going to open a T account, two T accounts. The cash, the opening balance being an asset, to be a debit balance of 50, because the question says the float should be 50. So this should also be the closing balance 50. The trade receivable opening balance, again an asset, on the debit side 1447, closing balance 1927. Then we are told general expenses 4,500, drawings 6250. Both of these, cash is going out, so we are going to credit the cash account for the drawings in the expenses. And then next we are told total bankings in the year amounted to 28,454. So again, this is cash coming out of the till from the cash account going to the bank. Again, you're going to credit
Just there on the 28454.
Yes, please.
Like as the question says, that's the total amount that total banking amount for that year. So you're taking
You've gone faint. I can't hear the question.
yes, on the 20, how are we going to treat 28454? The treatment that is given to it.
Yeah.
Seeing that that's like the total banking that is for that particular year. In short, I didn't get the treatment on how you treated the.
Okay. I get you. The 28454, we are told were total bankings in the year. You are working with a cash float. A cash float meaning this is a cash you are keeping on your premises. So this 28454 is cash which you are taking from the float, you are taking it to the bank. So the bank account, being an asset account, will be debited. The cash float account, being an asset account, is giving out cash, so the cash account will be credited. Is that clear?
Yeah, you have now answered my question. Yeah.
Okay. So we are done with all the figures, so we can balance up and get our closing balances. So when you close the cash account, you find that the credit side is more than the debit. The balancing figure means that's what you sold. So when you add the credits, you get 39,254. Subtract the opening balance of 50 to get 39,204. The 39,204, because this is a cash account, it means it's what you have received from your trade receivables. The trade receivables, remember, you're selling on credit, and being an asset account, each time you make a sale to be on the debit side, each time a customer pays you, you reduce your receivables by crediting the trade receivables. So the 39,204 will be credited to the trade receivables. Then you balance off the trade receivables by adding again both sides. The debit side, the credit side is higher. When you add those, you get 41,132. The 41,132, you subtract the 1,447 opening balance to give you 39,685. So the 39,685 were the sales, were the credit sales made during the year. Any question? Look through another example question. Bob owns and manages Biko, although he does not keep detailed accounting records. All of Bob's sales are for cash. He pays certain expenses from his till and then banks the remaining funds. Bob maintains a 1,000 float and operates with a margin of 20%. He has provided you with the following information. purchases of goods on credit, wages for clerical assistants per week. There are 52 weeks in a year. The 100 is given as per week. Stationery, electricity, banking, opening inventory, closing inventory. Bob is unsure of the level of drawings taken during the year, but estimates that they were between $60 and $90 per week. We are asked to compute or to find Bob's drawings during the year. Again, we've got a float account. We said when you've got a float account with whatever float you're given, that means that the opening float will be 1,000, the closing float, which will be a combination of cash and vouchers, should be 1,000. We're working on a cost structure of a 20% margin. We said when you're using margin, it means your costs are 100%. No, your sales are 100%. Then you subtract the margin, in this case 20%, from the 100 to give us our cost of sales of 80%. So we do our cost structure. Are we given the sales in the question?
No, we're not.
We're not given sales. Neither are we given cost of sales, but we are given opening inventories and closing inventories. So we can start by opening the cash account. The opening balance will be the float of 1,000. So we bring in the opening balance 1,000. We said that will be also the same as the closing balance 1,000. Then we've got what was paid out as cash. The wages for the clerical staff, 100 per week times 52 weeks will give us 5,200 as being paid out. Stationery and electricity are one-off payments of 500 and 1,200. 1,200 and 500. We bring those on our credit side. Banking is cash leaving the cash book going to the bank, 12.8. So the cash will be credited with 12.8. But we still need question is asking us about the drawings. We're just given an estimate of drawings. Can you compute your cost of sales using those opening inventory and closing inventory and the purchases? Give me the figure that you're getting for cost of sales. So we're able to calculate our cost of sales by using the cost of sales formula, which is opening inventory of 2,000 plus purchases of 20,000 minus closing inventory of 3,000 to give us our cost of sales of 19,000. Then using the margin formula, which we should by now be comfortable with, we get our cost of sales as 23,750, not our cost of sales but as our sales. So this is a cash which has come in, so we debit our cash with 23,750. Since we already have the closing balance, it means the opening balance that we'll be calculating now will be the cash which has been withdrawn. So you add both sides to get on the debit side 24,750, which is a higher figure. You bring it on the credit side as well, then subtract all the expenses from the 24,750 to give you 4050 as our drawings. Any question?
No question.
Okay, we continue the last part of the session in the last video.